Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. As I mentioned in the introduction to this series, I am going through Barron's each week, evaluating articles and the symbols they mention. The goal is to identify high probability trade setups based on the supply and demand lens we use at Precision Trading Labs. So let's take a look at what I found. Before I do, though, of course, the usual disclaimer. Precision Trading Labs, we are neither money managers nor financial advisors, and everything we do is for educational and informational purposes only. All right, so let's take a look at the charts here. So one of the articles that was in the November 20th edition of Barron's was they talked about while consumer staples, as represented by the XLP ETF, while the XLP and all of its holdings has been the weakest market sector, there are some specific holdings showing relative strength worthy of consideration. So what I did was I dug into the charts and I identified some high probability trade setups looking at the holdings of the XLP. So one of the ones that they talked about and looking at the charts here, this is a daily chart of Coca-Cola, KO. Okay. And so here's the daily chart. And if you notice the area that I highlighted um, right here, this area of consolidation is then followed by an explosive move out of this region here. In this region over here, what you're dealing with is a consolidation where supply and demand are in balance. If we think about the shares that are acquired by buyers, we can think of that as the demand for shares. We think about the shares that are offered up by sellers, we can think of that as the supply of shares in this region. And so within this area where price is going sideways, supply and demand are in balance. And right here, you have an exhaustion of sellers. No one's willing to sell here anymore. And so as a result, what's left in its wake, where there was supply and demand, there is now only demand. And so as a result, we call this a demand zone. And so when price returns to a demand zone, that is the basis and the foundation for a trade. And so what we're waiting for is for price to return to this region in order to then express a bullish trade from this demand zone. Okay. And so the two most straightforward, simplest ways to do that, of course, would either be to go long on KO stock, or the other way to express the trade would be to buy a call. All right. And so in this particular case, um, I would be looking to buy a call when price returns to the front of this zone here. This demand zone obviously has a top line and a bottom line. This is the area where we feel that we know what's going on here in terms of price and where price can be expected to react. If price drives through the zone and it goes appreciably below it, well, then in fact our trade thesis is blown, and this is where we would actually just get stopped out. Okay, so that's our risk management here. But when price pulls back here, again, we would be looking to either buy stock or buy a call. And in this particular case, I'd be looking to, and I already looked at the option chain. What we want to do is generally buy a strike just a bit below the demand zone, so that we're buying essentially an in the money call, so that we're getting a delta, let's say 55 or 60, so that if in fact we're right, we'll be suitably rewarded. And so that's the point of the strike that we're going to use here. And in terms of the expiration date, we buy time out into the future. We're not just buying it, 2 days or 2 weeks or even a month, because of the fact that we don't want to get too beaten up by time decay if in fact price comes down into this region and then we end up getting stuck in the trade. So that's the basis for that. So in fact, looking at the option chain, if in fact we get a pullback to this region, we would be looking to buy the February 20th, 2026 expiration, and we would buy the 65 call. All right. So that's the basis for that trade. Let me show you what one of these trades looks like if and when price actually returns to a zone and you end up with a successful trade. Okay. So here is something that we actually just closed this today. In fact, this is Boston Scientific. A couple of weeks ago, in Barron's in the November 3rd edition, to be specific. They had talked about medical devices. And so they highlighted various companies, one of which, of course, was Boston Scientific. So this dashed line here, this is what I was looking at the time a couple of weeks back. We're about 3 weeks ago at this point. And so this was the zone that I had laid out, which was a drop-based rally formation. Again, this was a demand zone. Okay. And so again, the thesis was when price returned to this region, we were going to anticipate a bounce out of it. Okay. And then this is where we would express a trade by buying a call. Okay. And so this ladder here represents reward versus risk. Okay, so right here we can see the depth of our zone here is in fact precisely $1 here. So if you were buying a stock, then that was, you'd be risking $1. If you got up to here, that would be a $1 trade, $2 of profit, three. In other words, that would be a 1-to-1, a 2-to-1, a 3-to-1. Okay, and of course with the options it'll be a little different, of course, because you're running delta. Okay, but nonetheless, that's the basis for that trade. Okay, so that's what these trades look like if in fact it works. Okay, if this thing didn't work and prices drove through this zone, as I said earlier with the Coke setup, this is where we would get stopped out. All right, so that's the basis for that. That's what one of these trades looks like here. So let's take a look at another setup here. Okay, so here is Monster Beverage, and we can see overall, even though a number of, as I said, the sector has been weak, there are any number of symbols within the sector that are exhibiting relative strength, and one of which is Monster Beverage. Okay, and so right here again, we have that area where we have this brief area of consolidation here, and then notice that very, very bullish candle here. So this is a demand zone here. And again, this came out of the this week's XLP roundup that they had done. Okay, and so we're waiting for price to return to this region, okay, to this demand zone, and then this is where we would express a bullish trade. Okay, when I looked at the option chain, there was no February strike. So I ended up looking at buying the March contract. Obviously, we're not going to be in the trade anywhere near that long, and in fact, we always want to avoid being in the trade when the earnings announcement comes out because we're not looking to be gambling on the earnings announcement. Okay, so but nonetheless, what we do is we buy enough time. And then we pay a little more for the time up front, and then of course when you close the trade, you get the vast majority of that time premium back. But the point is then you're losing less on theta buying this out into March as opposed to buying the December contract. And again, there was no February contract here. All right. So at any rate, that's the setup here. So again, we're waiting for price to pull back to 65.45, and then this is where we would then enter the trade and express it by buying a call. Or of course, if you're not interested in options, you could of course then just buy the stock outright. Okay. So that's Monster. One of the things also when I look at these articles in Barron's, I understand what their trade thesis is. Doesn't necessarily mean that I have to follow it. Okay, and so I'm happy. Over here, in fact, when I looked at this, this is Instacart, and so down here, this in fact was a demand zone. There was a drop base rally formation. Again, this is where the exhaustion of sellers occurred, and you could see then all that was left here was demand. And you can see when price returned here, in fact, you got a bounce here, and then we got a bounce here. And then, of course, it reversed today because, in fact, they did announce earnings today. And you can see it gapped up here, and then it kind of pulled back. So obviously, and you can see it was, and in fact, when it pulled back, it was pretty much back where it actually closed yesterday. When I took this screenshot a little while ago, you can see we were pretty much dead even with yesterday's close. So this zone is already kind of spoken for. I mean, it could work again if price comes back and kind of kisses the front again. But I think that there's some bearish sentiment just because the fact that that apparently they didn't love the earnings announcement. So what I'm going to do is, though, I'll keep an eye on this. If it comes back to this zone, we'll evaluate this. I'm actually hoping it's going to go up, because if it actually goes up from here, this is a supply zone here, and this is the same narrative that I told you about the demand zone. Of course, just turned on its head. Right here, this is an exhaustion of buyers here. Okay, and so when price comes back here, what's left in its wake is there is only supply now. Where supply and demand were in balance, there is no longer any demand here. There's only supply. Hence, when price comes back here, this is where we would express a bearish trade. Okay, so of course one could short the stock, and of course the other one can do, of course, is then to buy a put. Okay, so that's what this trade would look like, and so we would buy the February 20th expiration 2026, of course, and we would buy the 43 strike put, and then that's where we would get into the trade that way. Okay. Also, I have one more setup. Before I go through that, though, also I just want to let you know that if you look at the below this video, you will see a couple of pieces of embedded information. One is the table of contents for the current issue of Barron's, so that you can skim and see what the titles of the articles are. And then the other one is the link to the introductory video of this series, where I talk about the supply and demand lens. That's the basis for our trades at Precision Trading Labs. So if you look below this video, you'll find those two pieces of information. If you just click on those, you can grab those. Also, if you haven't done this already, please subscribe to our channel so that you always get notified of when I come out with a new one of these. All right. And then for the last setup here, this is Kroger supermarkets here. Okay, so in fact, this was in fact a demand zone here. Again, we're looking at the daily chart here. So we have a drop base rally formation. You can see price actually did come back here, and I didn't actually start to look at this chart until today. So I was not looking at this, and so you can see price did come in here. Price was stopped by this demand zone, and then it's had a moderate bounce out of here. But since I missed this and wasn't looking at this, we kind of look at this as the bus has already left the station. Okay, so this is no longer our trade. So what I would like to actually do is see this thing now bounce up, because if in fact it bounces and we get up to this region, this is a supply zone up here where we can anticipate that price is going to get knocked down once it reaches here. So the trade expression here, again, one could either short the stock here, or one could buy the March 26 expiration. Whoops, there's a typo there. The March 26, obviously 2025 put with the strike price of the 70 here. All right, and so that would be the basis for this trade here. All right, so in the next video, what I will be doing is we'll circle back and we'll see how the setups that I've been posting are doing. We'll look at what worked, what didn't work. We'll also update those that haven't triggered, and then I'll also post setups that come out of the next issue. So anyway, that's what I got here. Thank you very much for joining me. This is Mitch Firestone with Precision Trading Labs, and I'll see you next time. Take care. Bye-bye.